Yeah, hello guys. So I hope you guys are okay. And today we are going to handle one simple strategy for supply and demand. We are going to explain supply and demand from the beginning to the end, like from basics to at least the pro level, where you can understand why supply and demand is there and why it works. So we're going to work on supply and demand, and we're going to see the building blocks of supply and demand and how supply and demand should be traded and how their trading can help you reach your profitability. So let me share the screen. It's already been shared. So we have supply and demand as the basic strategy. So we need to understand what is supply and demand. So supply and demand are the fundamental economic concept that describe the relationship between the quantity of a product and the desire of the consumer who purchases it, and this influences the market prices. So that's what supply and demand is. Basically, it just shows the relationship between the produce and the demand for the product. So basics of supply and demand, that's the first thing we're going to talk about. So for the basics of supply and demand, we've already understood what supply and demand, that's done. Now we are going to talk about why do supply and demand work. So the reasons for supply and demand, why they work. So why supply and demand work. So number one, the reasons why supply and demand work is because, as we've seen, supply and demand influence market prices. So when supply is higher than demand, obviously there will be when supply is higher than demand, the prices will obviously go down because not a lot of people are in demand of that product. So the company or the people producing the product will have to lower the prices. And if demand is high and supply is low, obviously prices will rise because the market cannot meet the desired amount or the quantity of the products that are needed for are needed by the users. So that's why supply and demand work. And if we apply the same concept in the financial markets, it's easier to if you apply the same concept in the financial market, it's easier to see like how markets move, and you'll easily understand the process of of analyzing the financial markets and understanding why the markets move and the reasons why those markets move the way they are moving. So that's basically the building blocks. Like that's the reason why supply and demand work. Okay. So the second part we need to talk about is how to trade this supply and demand and what influences supply and demand. Now, before we talk about how to trade them, we need to talk about one thing here: market structure. We need to understand the market structure because supply and demand is influenced by market structure. So let's talk about the market structure basics. So what is market structure? Basically, market structure it just identifies the way a market is moving. So the movement of this specific market, that's what we define as market structure. For example, when a market is moving with higher highs and higher lows like this, we can tell that that's an uptrend. So that there is an uptrend because the market is moving in series of higher highs and higher lows. And when the market is moving from uh, with lower lows and lower highs like this, we can see that that's a downtrend. So that's basically market structure. That's all that is market structure. So that's what we call market structure. And we also have another one for consolidation or sideways movement when the market is moving in a like this in an horizontal way. So that's basically like this. This is basically sideways movement, or it's commonly known as consolidation. So that's market structure. So why do we need market structure when trading supply and demand? So when trading supply and demand, we need to follow the market trend because the supply and demand shows us where the market is moving to and where we anticipate the market to move to. So before even you mark your zone, you need to identify the market structure because the market structure basically acts like a map. So you need to identify it before you even mark any supply and demand zone. And when you're trading supply and demand, let's say you are trading supply and demand zones are respected in downtrends, and demand zones are respected in uptrends. What do I mean by that? So when you're trading on an uptrend like this one here, when you have an uptrend like this one, when you have an uptrend like this one, you can't trade supply. And when you have a downtrend like this one, you can't trade demand. Because supply and demand works with the trend and we don't trade on consolidation. So number one, supply and demand should, when you're trading demand, you're trading on an uptrend. When you're trading supply, you're trading on a downtrend. And we don't trade supply and demand on consolidation. So those are the key things you need to know about the market structure and how they influence our trading. So that's number one. Number two is you need to identify the trend before analyzing your market. So look at your market. You can draw trend lines. You can draw the higher highs and higher lows just to identify the trends. Once you identify the trends, that's where you know if the market is on an uptrend, you know that you're supposed to trade demand, and the market, if the market is on a downtrend, you know you're supposed to trade supply. So that's the basics, the relationship between market structure and supply and demand. Now we have this one here: how to identify supply and demand zones. So let me write it somewhere here. So how to identify supply and demand zones. Identifying supply and demand zones. How do you identify supply and demand zones? Let's start with one, identifying supply zone. Identifying supply zone. So I'll mark it with red. Supply zone. So when you're identifying supply, and you need to know what is, firstly, what is supply zone. So a sharp move away from the consolidation or base, or or strong selling momentum, that's where your supply is. And when there, and this is the first thing you need to identify. For example, if a market was consolidating like this, the market was in a sideways trend, then the market just went down with a sharp move. So this is where your supply zone is, this one here. You need to mark your supply zone at this area here. This area is where your supply zone is. So when you're trading supply, it's a sharp move away from consolidation, a base, yeah, consolidation and base. So that's where supply is. Like just like this one, you can see the market was on a side trend, on a sideways trend. Then all of a sudden, the market had a sharp move to the downside. So this is where your supply zone will be. So I'll write this one as supply. So after you identify your supply zone, what are you supposed to do? You're supposed to wait for price to come back to your supply zone, then go down away from it. So you will take a trade. So you're going to take a trade here with your target down here, and your stop loss just slightly above, some 10 pips above the supply zone. So that's how you're going to take your trade when you're trading supply. So let's recap that again. What is supply? Supply is is the sharp move away from consolidation or base, or basically strong selling momentum or pressure. So once you identify the consolidation, you need to find the sharp move away from that specific consolidation. Once you find that specific sharp move from that specific consolidation, that's where you enter for your sell. That's why you take your trade to the downside. So that's why you take a trade, just like that. That's how you identify supply, and that's how you trade supply. Now let's look at demand. So I'll duplicate this one here. Then I'll call it demand. So let's look at demand. Just like supply, demand also works just similar to supply. You need to find a consolidation or a base. We'll explain this in details when we are looking at the charts. So we have the sideways move like this one, like this. Then we have a sharp move to the upside. Like this. So what is demand? When you're trading demand, it's just simple to identify, to know what a demand zone is. So strong bullish rally from consolidation or brace or base, that's strong buying. So once you see consolidation like this and a strong move away from it, you need to identify your zone. So your zone will basically be this consolidation zone. Then you, what will you do once you know the zone that you have? You need to wait for the market to come back to that zone, tap into it, then you'll take an opposite trade. Like you take a trade towards the upside. So that's how we identify supply and demand zones. So you'll take a trade to the upside, your stop loss slightly below the demand zone. So that's supply and demand. That's how to trade now supply and demand zones when you're following the structure. Once you identify the trend, you need to identify anywhere where there is a sharp move away from consolidation, or we call it sometimes base depending, or a rally from a consolidation area. Then that consolidation area, that becomes your demand zone. Once you see the rally, you need to wait for the price to come back in and tap into your zone, then take the trade towards the upside, or if it's demand and supply, if it's to the downside. So that's how to identify the supply and demand zones and how to trade them. So we're done with the supply and demand basics, like why they work. Now we will look at why supply and demand work. This is a common question. Uh, why do you trade supply and demand? Why does it work? So one, we need to identify a few things, like we need to know a few things when we're trading supply and demand. So number one, when you're trading supply and demand, we are basically trading with the institutions, because these sharp moves that we are waiting for before we trade. So institution place trades or orders at certain price levels. So when you see a sharp move like this one, you'll get to know that this is not trader that caused this specific move, or these are not small orders that caused such a move. So these moves here were not caused with small orders. These moves were caused with big orders. So the reason why supply and demand works, number one, is because these orders, large institutions place their orders at certain price level. So we need to identify these levels so that we can follow it. Then number two, why we trade supply and demand is because we want to trade with the institutions. So when we're trading supply and demand, we want to trade with the institutions. So let me show you. Why am I saying we want to trade with the institutions when we are trading supply and demand? So when you're trading supply and demand, institutions are, when you get to understand, okay, you know, like you have it in your mind that when I'm taking this trade, I'm not only taking this trade as a retail trader, but there are banks trading at this specific level, big institutions, hedge funds, uh, people are trading at this level, and you are given a higher win rate, because you know when you're trading with institutions, your likelihood of losing money is low. So number two reason why supply and demand works is because you are trading with the institutions. You are trading with the institutions. So that's number two reason why supply and demand works. Then number three, last but not least, when price revisits these zones, unfilled orders create sharp reactions. So this is the main reason why supply and demand work. So it's as easy. This is the reason why supply and demand works. Control. Yeah. When prices revisit these zones, when prices revisit these zones, unfilled orders create sharp reactions. So we need to understand this in a deep way. Like we need to understand this in slightly a deep way, because when supply and demand, when you're trading, so when you'll be trading, so let me just draw something here so that I can use it for my explanation. So we have, that's the first block. Then we have the second block. So we'll have here, let me just write here bid. So we'll have bid, then we'll have price, then we'll have, so after the bid, we'll have the price and we'll have the ask. Now, I want you to pay keen attention to this. So, why am I drawing this here? So, we always have prices at these specific levels. So, all these here, the numbers you'll be seeing here, they are basically these numbers here. They are these numbers, just give me a moment. There are these numbers here, the numbers you are seeing on the side, all these numbers. So these are the prices, right? So all these numbers will be in between here. So there will be prices here. Then we'll have orders. So bid orders are basically buy orders. So any number you'll be seeing here, any number you'll be seeing on the bid section here, these numbers here are uh, are orders placed by people that want to buy uh, an asset at a specific price level. So let's say someone here wants, someone down here wants 10 orders. So I'll come here, then I'll write the 10, want 10, want to buy 10 lots uh, of these at, let me pick a price, 700, 23,700. So this person has an order here, a buy order to buy 10 lots of this specific asset at this price at 23,700. So this person wants to buy this price at this level. So for this person's order to be filled, someone should be offering to sell to sell their to sell their own levels at the same price, 23,700. So someone should be able to offer 10 lots at this specific price. So for a trade to occur, the buyers and the sellers should agree on, must, not even should, must agree on a price. So if I want to buy from you, we have to agree on a price for the trade to occur. So that's the main reason why supply and demand works. So once these prices, let's say this person only has one. So this person here with this order here will be filled with the next opposite price. So let's say $23,700 as the price that they want to buy 10 lots of these specific assets. Now this person must offer 10 lots of these specific assets. But if this person can't offer the 10, a few orders will be filled, not orders will be filled. And now when you want to identify aggressive buyers or sellers, they will not place their orders like this. They basically enter the market, and when they enter the market without waiting for specific price, they will eat up all these prices here, causing imbalance. And these imbalances must be rebalanced again. So markets will come back to balance these prices, then go head back to the same direction. So that's what causes the sharp move. You see here we said demand zone here. We say demand zone occurs when you identify a demand zone after a sharp move away from a consolidation or base. So this one here is what shows you that big institutions have entered the market and they are placing their trades at this specific zone. So this is basically this consolidation of the base before the sharp move is just accumulation of orders. So once the orders have been accumulated, they'll be distributed. And that's what causes the sharp move. When prices come back to this zone, since not all orders the market filled at this zone, the market will fill the orders and head back to the same direction. So that's the simplest way I can explain why supply and demand works and the reason why price creates sharp reactions from these supply and demand zones. Hope that's clear. You can tell me in the comment section if that's clear, or if you have a question, you can just ask me the question right there. So we're done with the reasons why supply and demand work. Now we need to understand now the analysis. After we understand the analysis, we are going to talk about the entry criteria, then confirmations on lower time frames, then we'll finish up with risk management. So we'll now look at analysis, and we'll start with top-down analysis. So just a minute. Yeah. We're going to look at analysis, and we're going to work with top-down analysis. So top-down analysis. So what is top-down analysis? Basically, top-down analysis is analyzing your market from starting from the higher time frames moving to the lower time frames so that you can get the bigger picture. So how do you do your analysis for supply and demand zones? So there are three steps where this is how personally I do it. You now need to find your own way of doing it. So number one, for top-down analysis, number one, start from the higher time frame, daily or the 4 hours for trend direction. So that's where we already talked about market structure. So this is how you now identify the market structure. Start from the higher time frames, the daily or the 4 hours, identify the trend of the market. Is the market on a sideways move? Is the market on an uptrend? Is the market on a downtrend? You need to identify that first. So number two, the second thing you need to do is you need to mark your supply and demand zones on these higher time frames. So mark key supply and demand zones on higher time frames. So once you identify the supply and demand zones, you need to mark key supply and demand zones on the higher time frames. Why do we mark supply and demands on the higher time frames? The higher time frame supply and demands are more likely when price comes back to these zones, they will react to these zones, unlike the lower time frames. So the higher time frames are much more safer. So the third thing you need to do. So I say there are three steps to this supply and demand zones. So number three is drop down to lower time frames, 15 minutes, 5 minutes, or the 1 minute for entries inside these zones. So number one, start with higher time frames, the daily or the 4 hours for trend confirmation. Confirm the trends of the market, like confirm the trend where the market is moving on. Then number two, mark key supply zones on this higher time frame. Mark the supply and demand zones on the higher time frames. Number three, drop down to lower time frames, the 15 minutes, 5 minutes, and 1 minute for entries inside these zones. So that's simple. So those are the key steps when you're doing your top-down analysis. I'll show you that in action. So after you identify all this, you need to define your entry criteria. So what's an entry criteria? Basically, criteria just shows what you're waiting for before you can take a trade. So for the entry criteria, so number one, wait for price to tap into your supply or demand zones. Don't take early entries because you're scared of missing out on the trade. So wait for price to tap into supply or demand zone. So once you wait for that, look for rejections or wicks or engulfing candlestick. Basically, look for a reversal confirmation. So there are several ways of looking for ways of identifying reversals. So number one is rejection wicks. So when the price taps into your demand zone or supply zone and price rejects with a strong wick, you'll get basically that communicates that that level is holding the price and price is likely to bounce back from that specific zone. Number two is using the candlestick pattern. So there are a lot of candlestick patterns that you can use. There are a lot of these patterns. So even if you just go to Google, to your browser and search reversal, reversal candlesticks, if you just search reversal candlesticks, then you go to the images, you'll see a lot of them. There are a lot of reversal candlestick patterns. For example, let me open this one. You can see we have the evening star, we have yeah, there are just a lot. We have the tweezer top, we have the morning star. So all these are reversal patterns. So you need to go research, understand the reversal patterns that you need to look out for, and use them as your confirmation when you're doing when you're confirming your entries and everything else. So look for rejection wicks or engulfing candlesticks. So we're done with that part. Now that's the second part. Now let's go to the third part. Confirm. Confirm with structure, break or momentum shift. So let me explain this. I'll add it there. Confirm with structure break or momentum shift. Here's something I was almost forgetting to tell you guys. Let me just draw it somewhere here. So let's say the market is on an uptrend like this. This is an example. Market is on a beautiful uptrend like this. Okay. Now, let's say you've marked your demand zone like this. No, just a minute. Let me add something. So the market came back down like this. Okay, so let's say you mark your demand zone like this. Let me mark it here. Demand zone like this. Your anticipation is that price will come back to this zone and it will react from this level. So that's basically what you want. That's what you want to see. Price coming back to your demand zone and reacting from this demand zone. Now, there is a few things I wanted to tell you. If so, what you're seeing right now, the drawing you're seeing right now is the correct way of marking this supply and demand zone. But if this sharp move did not break the previous high, you can see the previous high here was not broken here. If price did not break that high, that invalidates that supply, that demand zone. Why? Because we need to see a strong momentum that breaks the previous market high. So once you see such a move, just know this here is a strong zone and price is more likely to tap it back into this zone. Price is more likely to tap back into this zone and head up like that. So that's the basics of identifying these zones. What's this? So that's number one thing. You need to make sure that you get a break of structure before you validate that supply and demand zone. Because without the break of structure, if the move was strong enough to break structure, then you are sure that that specific zone is a strong zone, and not only are you trading that zone, but also big institutions are trading on that zone. So it's that simple. Confirm structure break or momentum shift before you validate a section. Then last but not least in this section, enter with stop loss above or below the zone. So let me write that one down here again. So enter with stop loss above or below the zone. I already marked that one somewhere here. Let me just reload it like this. So we have this supply zone. So you can see I marked my supply at this level here. And I said if price comes back to this level, you're going to trade towards the other side. So where should you put your stop loss? If you're trading supply, just put it slightly above the supply zone. Like this at this specific zone, you can see my supply zone is slightly above this level, and on demand zone slightly below the demand zone. You can see it's just slightly below the demand zone. So that's how to mark your supply and demand zones. It's that simple. Marking on how to mark the supply and demand zones. And stop loss, where to put your stop loss. So slightly above the supply and the demand zone. So that's the entry criteria that you need to look at when you're trading supply and demand. Those are some of the main things you need to keep note of. So enter with stop loss above or below the zone. Now I said when you confirm and mark your supply zones on higher time frame, you need to also do what you need to confirm on confirmations on lower time frame. So you need to confirm break of structure, because I said you can see we said on top down analysis, the last part we said drop to lower time frames, 15 minutes, 5 minutes, 1 minute for entries inside these zones. So inside these zones you need to look for number one, break of structure. I just explained that right now in a few minutes ago. I just explained break of structure. This here, what I explained here, this one, you need to confirm the break of structure. So that's the number one thing. Number two, liquidity sweep. Now, this is also something very important to identify, liquidity sweep, before you enter for your supply and demand trade. Now let's look at this liquidity sweep in a very simple way. I'll just go back to this example. So when this price comes back down here, and you notice that the price moves even lower than that anticipated price or anticipated zone. Now, this down here, this is what we call liquidity sweep, a fake out. So when the price fakes out and goes even lower than the expected price, so that's liquidity sweep. Price went down, swap liquidity, fake out. People thought that the zone was not going to load to hold. If there was someone who entered early, someone entered their trades here, their stop loss are down here. All those trades will be all those people will be stopped out because their stop loss is below that zone. Yeah, it's just basically the stop loss and the fake out to maybe tell people that this price is not going to hold. You need to enter for sales at this level, and without noticing, price goes back and heads up straight up. So these are things you need to confirm before you enter for a specific trade. Confirm for those liquidity sweeps, break of structure. Now you need to look at the rejection candlesticks. So after you confirm your break of structure, so you need actually these are just full things that like in details what you need to look out for. But when you are doing your own testing to the strategy, make sure you do a lot of filters to ensure that your strategies are are fitted to your trading method. So if your trading method basically looks at a specific thing, make sure the price is fitted to that specific method. So you need to look for rejection candlesticks. We talked about that. Then momentum shift. So if the market was coming back down, let me just write that momentum shift down here first. Control. So if the price was coming back down, I'll just go back to this example here. So if price was coming back down like this, you can see the market is on a bearish move. Then all of a sudden you get a strong momentum shift at this level. You start seeing green candlesticks going upwards. That's what we call momentum shift. When you notice that it was on a bearish market, now the bullish candlesticks start forming. That's what we call momentum shift. And once you see momentum shift, either bullish or bearish, that's when you're supposed to pick your entries. So basically, we've done everything you need to look out for when you're trading supply and demand. Now, number two, the most important stuff you need to look out for is risk management. This I don't even need to talk about it so much because this is something all traders should know unless there's a beginner trader here. So we have risk management. Number one, never risk more than 1 or 2% per trade. For small accounts, 100 to 50K, 100 to 500, use 1%. So risk 1% of that account for every particular trade. Even if you take 10 trades in a day, make sure you are risking only 1%. Number two, for medium-sized accounts, 1K to 5K, use 1.5%. For large accounts, 10K plus, maximum 2%, because consistency is more important than high risk. The lower your risk, the more you'll stay in the markets, and that's basically supply and demand. That's how to trade supply and demand. If you are in for the long run, you need to identify these risks. So once you identify this risk, and if someone is asking, how will I grow my account with this risk management model? So let me show you. If you're asking how you'll work with the risk management model, this is how you're going to do it. Account growth plan. So if your account is at 100, if you have $100 account and you're risking 1%, if you lose that trade, you will lose only $1, and that gives you a chance to attempt 100 trades. So you can attempt 100 trades for you to lose the whole account. 100 trades and you're losing all of them, that's slightly impossible. Number two, let's say you have $500. If you risk 1%, you'll only lose $5, and that will also give you 100 attempts. So after 100 attempts, that's when you can lose the entire account, and the list goes on and on. Then psychology and discipline. So supply and demand requires a lot of patience. So when you're trading supply and demand, it requires you to have a lot of patience. What patience am I talking about? Let me answer a question here. Mad is asking, does demand and supply work on synthetic indices? Okay, I'll explain that. That's a very important question. I'll explain that before we end our live. So I'll explain that on supply and demand on synthetic indices. That's something a lot of that's I've not received that question for the first time. A lot of people ask that, so I'll explain that. So we have psychology and discipline. I just go over here, discipline and psychology. So let me just add it here with the text, then let me add it here. Control V. So psychology and discipline. Number one, patience. Only trade quality trades. So if you notice, the way I was explaining here, I said if this demand zone, if this price did not cause a break of structure like this, then that's an invalidated demand zone. Don't trade that specific trade. Just let the trade. Don't trade that specific trade. Number two, we said if price didn't come back to your zone and it reacted, let's say from somewhere like this, no need to chase the price. Even if the price did not come back to your demand zone and it reacted to a specific zone above your demand zone like this, just let the trade go because you don't want to force the trade to come to you. Trades will come, and the less trades you take, the quality trades you take, the more your zones or the more your risk to reward will also increase. Number two, discipline. Stick to your risk rules. I've given you this risk here. Never risk more than 1 to 2%. And even I've given you the account sizes. If your account is less than 100, only risk 1%. If your account is more than 10,000, don't risk more than 2%. That's if you have $10,000 in your account, you are going to risk only $200 per trade. And do not revenge trades or over leverage. For example, over leverage basically is what people call full margin. When you enter the trades with everything, meaning if the trade goes against you, you lose everything. So that's basically full margin. Don't trade full margin. This I always tell people every now and then. Don't trade full margin. Number two, don't revenge trade. So if you lose one trade, uh, you come back later, you find another zone, you lose that trade. You can even stop for the day because that's a two. If you are risking 1% per trade and you take two losses in a day, then that's a 2% loss. You need to stop. That's how basically you need to do it. You need to stop at 2% if you are doing your risk management well. So number four, the last but not least, focus on long-term consistency, not quick wins. So for the long-term consistency, it's simple. Like here's an example. If someone is doing full margin, meaning they only risk one trade to lose everything or to make something, or they lose everything like totally and nothing changes, like they just there and they have to look for another capital again and start afresh. So that's what we call focus on long term. So let's now look at something here. Now, I'll just call this advanced concepts, but they are not advanced at all. I don't even know why I call them advanced concepts. So we have these, what I call the advanced concept. Number one, refined zones. Smaller zones inside big ones for sniper entries. So for you to get sniper entries, okay, this here was a simple model. Wait for price to come back and you trade from this specific zone. But there's something you need to also confirm. Let's say you get a clear picture now, a big picture of inside this zone. So I'll just extend it so that I can get this zone clearly. Because price won't just come sharp and go up. Price will inside this zone. Price will also create its own market structure. Price will come back down, something like this, go up, come back down like this. Then market will break like that, come back down here, then now start going. Because this is how price moves. Price won't move in a straight line. So, okay, so now why I was saying, why that line is saying you need to refine smaller zones. For example, inside here, you can see we're assuming this picture here. Now, this is the detailed picture or version. You can see price was on downtrend. Then we had a break of structure of this level here. So we had a break of this level. So that's a break of structure. Now, this break of structure will also act as our demand zone. So this here will be our demand zone. This zone will be our demand zone, this one. So you see we have a demand zone inside a demand zone. Okay, what's that? I need an arrow. Where is that arrow? Yeah, that's it. So you can see we have a demand zone inside a demand zone. So this is for the sniper entries. You can see you have a demand zone that's living inside another demand zone. And that's how you identify your sniper entries for sniper entries, basically for you to get good quality trades. Number two, order flow. Watch how liquidity builds up before the zone. So I'll explain that multiple time frame alignment. So if your demand zone is on a higher time frame and confirmations on lower time frames match like they are to par, then that's the best thing you need to do to trade that specific zone. Then institutional footprints, spotting where banks place orders. Now you'll need a footprint chart for you to identify that one. But this is just advanced concept. You can trade it without the footprint charts, but if you want precise entries and everything, you can use them for your use case. Then we have almost the second last part before we enter into the charts and see this in action. So we have now let's look at a case, basically case studies. Okay, I want to delete all the drawings here. So yeah, I just deleted all the drawings that were on this zone. So let me look at anything here if I can find a supply and demand zone inside this chart. This chart is choppy. So let me show you an example trade that I was waiting for and I missed it. So I had this trade here. I missed the trade, and this is what I was telling you: don't chase trades. So number one thing, we had the rally base rally. Basically, let me delete everything. Then I start again. I start afresh. So delete all drawing. Yeah. So I've just deleted all the drawings. So this is on the 1 hour time frame. So I'll go to the 4 hours time frame. So this is on NAS 100. So I'll go to the 4 hours time frame. Why am I going to the 4 hours time frame? I want to know the market trend. Basically, that's what I want to know, the market trend. What's the current market trend? Then I'll come here and I'll use the ray tool to draw my trend line. Where is that ray? There. So I'll draw the trend. I don't know how you guys draw your trend lines. If you draw them on your I don't know, on your wicks, or you draw them on the candle body, that's something I cannot negotiate or tell you which one is best. I personally draw them on the wicks. So then we'll go back to the 1 hour time frame. So the 4 hours time frame, you can see clearly the market is on an uptrend. Then I'll go back to the 1 hour time frame. Once I go back to the 1 hour time frame, let me just reset the chart. So this trade, here, I was actually waiting for price to come back to. Let me draw a box here so that I can show you something. You see where that box is? You see where that box is? I've written it no data. So the only thing I was seeing when I was doing my analysis was before this specific box here. Was before this specific box. I actually have a screenshot of the chart before. Let me just find it here. Gallery. Okay. Let me just give you the screenshot because I had a screenshot of the trade before I did the analysis. Let me see if I can find the screenshot. I think it's in downloads. Basically, let me see. Yeah, I just found the screenshot. Let me open it and share it here. Okay, let me drag the screenshot here. I hope you guys can see the screenshot. So this was the screenshot when I was doing the analysis. This one here. This was the screenshot when I was doing the analysis. You can see there was no data. This data here was not there. So when I was doing the analysis, I marked my rally base and the rally, then I marked the demand zone, and I was waiting for price to come from this zone down to this zone for me to take a buy from this level. So let me close the screenshot. I don't think we need it. So I just wanted you to see where the data was. So number one, what I saw in this chart, there was this rally, you can see, there was this rally. Then we had a consolidation. Sometimes I call it base. So we have rally, then we have the base, then we have the rally. Now, the reason I marked the base as my supply, as my demand zone, this zone here, I marked it as my demand zone, this zone. So that's this zone here will be my demand zone. Now the price was up here. So this here was the rally, then the base, then the rally. So the reason I marked the base here or the consolidation as my demand zone is because as long as you see consolidation, that means orders are being accumulated at that specific level. So when you see this consolidation, orders are being accumulated at that specific zone. Then we had the rally to the upside. Now, what I was anticipating was for this price, just like you saw it on the image, I was anticipating for price to come back to my demand zone. Then I'll drop to the 15 minutes, then to confirm a precise entry, then take this buy. So that's what I wanted. That's what I wanted to do, but it did not happen. Why? Let me remove this one, this block here, delete. So here's what happened. You can see price came back down, but not to my level. Price came back to this level down here. Price came back to this level, and it went back up. So there is something also I when I was doing the analysis I missed. So you see here there are a lot of weak rejections at this specific level. So from my trading, like how I notice it, anytime you see a lot of wicks at a specific level, there is also supply and demand at that specific zone. So this one here was also a supply and demand zone. This one here. So this one here was also a demand zone. And I didn't see it at all. Like I missed it. But the good thing, I did not chase the trade. After the trade came back down to my zone, I didn't like if the way it felt, I didn't chase after it. I just let the trade run, and I missed that trade. So we had two demand zones, and I missed this one. I didn't see this one coming here, and even if you've traded for a long time, such things will happen when you'll miss some trades because of some things you didn't see. So that's what happened. I missed that specific trade. The demand zone was there were two demand zones. I only focused on one. I didn't see the other one, and if I had seen this one, I must have entered the trade because you see there was how do they call them? A doji candlestick here, and this is on the 1 hour time frame. So a doji candlestick on the 1 hour time frame signifies strong rejection. So this is where I should have taken the trade. I didn't take the trade. I'm not regretting not to take the trade, but this is where I should have taken the trade. Stop loss slightly below my demand zone. Then my take profit should have been on a risk reward of 1:3 and above. I don't take trades on demand on less than 1:3. So if you are taking this trade and you are risking, let's say you are risking $10, you should have made $70 because this trade was a 1:7.4. So you should have made $70 if you are risking $10. You should have made $70. If you are risking any amount, if you are risking $1, you should have made $7 in this specific trade. And I already talked about this before, but let me just say it here again. When you are trading, maybe you can take a screenshot of this. Let me just bring up the screen, the image. You can take a screenshot if you don't have the. Let me get it here. Nice. So what you're seeing on your screen is a chart showing profitability when you merge it together with risk to reward. So if your risk to reward is 1 to 1, you need to be right 60% of the time for you to be profitable, and you need to be right 50% to break even. You need to be, if you are right anything from 40% and below, you will not be profitable. So you can take a screenshot of this. I don't know if, no, I can't send an image here. So you can take a screenshot of this and you can study the chart and understand it. So anywhere, if you take a trade with a risk to reward of 1:3 and above, you only need to be right 30% of the time. That's why I was telling you there is no strategy that's 100%. So just use your strategy, apply proper risk management. Even if you are losing 70% of the time and you only write 30% of the time with a risk to reward of 1:3, you will be profitable. So if someone, I know that sounds weird because someone is losing 7 trades and they're only winning 3 trades and they are already profitable. You see, that's something good. So you need to be right only 30% of the time. So 3 wins and 7 losses and you are profitable, that's enough. So screenshot that chart, you will use it for your confirmations later. Yeah, that's it for that screenshot. And that's how I missed this trade. I hope I've explained it to you. So this is number one way of identifying supply and demand zones. The base after a move to the upside, consolidation, then a sharp move to the upside, because you can see here we have a very strong bullish candlestick going to the upside. This one here. You can see there was a strong move after that breakout, and that's what confirmed to me that that's a demand zone, a strong demand zone, and I was anticipating for price to come back to that zone. Number two, if a zone was already tested earlier, you should avoid trading that specific zone. Now, you can see this zone here, the demand zone here, was already tested here. Now, if you wait for price again to come back to this zone so that you can take another trade, let's say you wait for price to come back down to this zone so that you can take another trade, it's likely that trade won't hold up to what you're expecting. So don't take trades like that. Once a zone has been tested, just let it run. Avoid trading that zone again. So that's it for that supply and demand zones, on how to identify those zones. Yeah, I don't see anything I can add. For the question on the reef synthetic markets, and the question was, do supply and demand work? The simple answer is no. Supply and demand won't work on synthetic indices because these markets don't follow the these markets don't follow the actual market, like don't follow supply and demand. There is no supply and demand on synthetic indices. So you should not trade supply and demand on synthetic indices. So yeah, it's that's simple. Supply and demand what work on synthetic indices. Trade supply and demand on real markets. When you're trading synthetic indices, you can trade even simple strategies like trend line. You can trade breakouts. You can trade bounce from levels. It's that simple. For synthetic indices, don't focus on supply and demand. Now I've also noticed another supply and demand zone here. So let me mark it so that you can see, and it's a very good one. You can see here we had this consolidation at this level here. So this here is another demand zone. So you see, this strategy is just a rinse and repeat. Once you took this trade, you can see there is another demand zone here because there is this rally. Let me draw it so that you can see it. We have the rally, Okay, just a minute there. So we have the rally. Where is the okay? We have the rally like this. Then we have the bears here. Then we have the rally. You see, another trade. So this here will act as your demand zone. This one here. So you see, price has just come back into that demand zone, and now it's reacting from there. Rinse and repeat. Just mark those zones like that, then you'll keep going. For mad, okay, thanks Muku. Sawa, kama your explanation is simple hivyo, but yeah, synthetic indices won't work on. Okay, let me show you something on synthetic indices that I've been using for quite some time. Okay, let me just go to charts.deriv. Then the first screenshot you'll see. Sawa sawa. Next class, funza price action. Okay, I'll do that. So let me go to the let me just stick to the 24 hours. Then I want to go from the beginning of this chart. So this chart started on September 16th, 2024. That's when this chart started. Volatility 25 index on the 24 hours. So I want you to see something on synthetic indices. This synthetic indices market, basically, this level is on a downtrend, right? So if you draw your trend line like this, you are on a downtrend, right? And this is on 24 hours. So you can trade the downtrend. Then once you get the break, look at this. You get a very nice clean retest here. So you had a very nice retest. Then we had an uptrend. So let's say after the retest, you entered for a buy. Let me draw something. What do I want to draw? I want to draw a trend line. So I want a trend line 3. So I'll come with another trend line here. I'll draw it there. So you can see you entered for a buy at this specific level. And this is how synthetic indices is simple to trade if you understand it. And I just picked the default volatility. So just like that, you had a 1:3 trade. Now, this upward trend lines, the upward trend that you drew here, let me turn it to green. This upward trend line has been broken. Look at another retest at this specific level, another clean. Let me raise that arrow. Then another clean retest at this level. Then you come with your array tool again. Then you draw the downtrend here. Let's say you entered for a sell at this specific level. You exit the market at this level because the upward trend line has been broken again. So you will have to draw another upward trend line after that downward trend line has been broken. So you draw another upward trend. Where is the ray? I need the ray tool. Where is the ray here? You draw another upward trend line at this level, at this price level here. Then the more the trend lines add up, the more you now delete some trend lines that you are not using, like these ones here, you can delete them. Now you entered for a buy at this level, the price went up like that. You follow the trend. If you missed this entry, you get this entry. Here, let me show you something here also. This was a very nice move. Here you have this. Basically, if the more you'll be trading supply and demand, you'll also notice that support turning to resistance, resistance turning to support. That's supply and demand. You'll just notice it as the more you trade. You can see here there was this resistance, it turned to support. So if you missed this entry here, you can enter at this level. Which this level was caused by this level here. You can see there was a resistance at this level. It turned to support at this level. Price came back down, went up. Now we had a break of structure, and now this resistance turned to support. Rinse and repeat. That continues up to the top where the upward trend line was broken. You can see this resistance here turned to support at this level, and just like that, till the upward trend line was broken. Now you took a buy here. Now the upward trend line has been broken. You are supposed to look at the downward trend now. Now you come with your ray tool again and draw the downward trend like this. Okay. Now this was broken. You entered for a sell at this specific level. Now you had all these cells here. Now you are down here, like you are down here. The trend line has been broken again. Now you also draw another trend line. It's just a rinse and repeat. And if you make losses, small losses around the way, it's okay. But this is just a rinse and repeat. So you had an upward trend, a short one again. It was broken. Let's say you took another downward trend line. Basically, I can do this forever. You can see we had a downward trend line. It was broken again. You entered for a buy again. You can see the upward trend line was broken, downtrend just like that. And here, downward trend line was broken. You enter for a buy. The upward trend line is broken. You enter for a sell. The trend is broken just like that. Rinse and repeat. It's that simple. Not very simple, but it's that simple. The more you do it, the more you'll understand what I'm trying to say. So that was it about supply and demand. And I think I'm done with today's lesson. If you have any questions, you can leave them in the comment section. I'm going to send a PDF. So let me show you the PDF here. I'm going to send this PDF. This is the guide I've been using for this class, supply and demand guide from basics to advanced. So these are not notes for you to trade. This is a guide. The one I was using to do this class. This is a guide. I'm going to send it to our Telegram channel. And yeah, that's it. Also, next month we'll have a giveaway next month for okay, let me look at it. Let me look at the date. Just a minute, let me look at the date. So next month we'll have a giveaway for a 5K funded account challenge. It's not fully funded, it's a challenge account. And we'll pick we're going to pick the people who are going to get that account. If there are two accounts, so 5K, 5K for two people, we're going to pick them from my Instagram account. So you can follow the Instagram account, and I think that it's a new account. There is one video. Like let me confirm that account right now. Instagram. So it's a new account. I think there are 3 videos in that account. You're supposed to follow that account and comment on the first video there. Just comment on that video there. The name Desync Traders. Then from there we'll use a comment picker to pick a random comment. And you might stand a chance for that. Also share the Instagram account link for the people who are asking. If you might ask where is the Instagram account, below this, like on the description of this live, there is that link to the Instagram account. Just click on it, follow, do that, share to at least one person. Then yeah, we'll use that to pick someone. And that's it. I'm done with today's live. If you have a question, leave them in the comment section or message me directly. end. I think I'll end the live from here.